Hey traders, this is Blake Morrow with Trader Summit, and I'm so excited. Today I have Mr. Richard Matthews from One.io and Mr. Michael Brown from Pepperstone. Good to see you guys. How are you?
Very well, Blake. How are you, mate? Good to see you again.
I'm doing well. You guys look bundled up. You look like you might be cold over there.
It is pretty cold, and we were just outside before this. It is very cold.
Yeah, it's very cold, and my right hand is freezing after holding a very cold beer before this recording as well. So
good.
Winter has definitely arrived in London.
Well, we got you drinking. That's great. I can't wait for the slip-ups for this one, and we're not editing anything out, so I'm excited about that.
Well, he'll be all right.
I'm okay. I never swear.
Well, speaking of all right, Richard, we've seen this blast higher in Bitcoin. I had a conversation with you last week. You were very bullish on crypto. What's happening with Bitcoin? We're above its 50% retracement of its all-time high to its recent drop.
I think it's the same story, as everything, as every other asset. There's a lot of money floating around. All goes back to the QRA when they actually came out with less refunding than they thought they were going to come out with. Liquidity, Fed going to ease. We don't know when, but the market's obsessed that it's going to ease or the next move is ease. So I guess there's a lot of that just pumping it higher. Same with gold.
Well, first of all, I just want to say great call. So where are we going now? I mean, where are we going next? I mean, do we keep?
No.
Come on.
No. I've called it twice this year. That's been done and dusted.
You've not got your crystal ball.
Yeah, hold on a minute. I'll look into my crystal ball for you.
I've just heard if you own crypto, sell it. That's all I heard from you, Richard.
Yeah.
Book it. I've never met a rich trader going broke taking profits. So there you go.
Exactly. You don't go bust taking your profits too early.
Well, let's talk a little bit about liquidity. What pushed gold higher? Michael, maybe you might have a better answer to this, or maybe an answer to this. We saw this blast higher in gold to start the week. What gives?
Do you know what? I actually think to a certain degree that, and fair enough, some of this has begun to pare back over the start of this week. But I think actually a lot of what we've seen over the last 4 or 5 weeks has just been the same trade, where everyone has kind of sat down and gone, I don't really want to just sit in cash anymore. And I'm going to buy whatever I can buy. I mean, the S&P 500 has notched 5 straight weekly gains. It looks set to snap that streak this week. Treasuries have continued to rally, obviously. Gold got through to those new all-time highs, although 2 o'clock on a Monday morning, the market is so illiquid, and we paired that very quickly, which actually is a little bit of a warning sign if you are a gold bug out there. And as Dick said, Bitcoin has been rallying as well. So I think it's just all that kind of combination of liquidity coming into the market, a bit of a momentum trade, and also the fact that we're going into the end of the year. You've probably got this fear of missing out coming in as well. And you kind of put all that together, and you just get this this momentum that just rolls on and on and on. But I do think actually the way that gold traded yesterday, and I'm not a gold expert by any stretch of the imagination, but just purely looking at the chart, we popped to those all-time highs, 21.40, I think it was, in the cash market, and then it was just sold relentlessly and closed below the resistance at 20.75. And I just wonder whether that's the first sort of chink in the armor of this quote-unquote buy everything rally that we've seen over the last 5 or 6 weeks.
I think it's really strange that people are buying the S&P on the basis that the next move in interest rates is down. Well, what's going to spur a cut by the Fed? A recession. So I buy equities into a recession. It's just like, I can't quite square that.
It's interesting you bring that up, and we've got obviously interest rates that are trading about 5.25 or whatever, wherever they're at right now. But I go back to the beginning of my career in the late 90s. Interest rates were basically, at 4 to 6% roughly. And we're I guess what I'm trying to say is we're at the top of the range right now. But if you go years back and you go, from into the 80s and in the 70s, they were much higher,
and further back in some cases.
Right. And so you remember those days. And I think this is one of those really interesting, times. Here we are at the end of 2023 when we're going to take a step back and we're going to see, we're going to look back maybe 12 months from now and say, wow, I can't believe the market really was pricing in, a full percent or more of rate cuts into this year. So is that kind of where you guys are at as far as your thoughts are?
It is for me, actually.
Yeah, I would agree. Yeah, I think I can understand why the market is pricing the easing that it's pricing, because not just in the US, particularly in Europe, you look at the data and the message is clearly that disinflation is continuing, and actually continuing pretty quickly, getting back towards that 2% target that central banks have. And also economic momentum on the growth side of things is waning, and that is clearly softening as well. But I think it just comes back to that tendency that markets have had, since day dot, really, to underprice hiking cycles and to overprice easing cycles. And arguably that's what we're seeing again this time around.
I think it's also,
Go ahead, please.
I also think there's this process that central banks kept interest rates much too low for too long.
Yeah.
Are they now going to keep interest rates too high for too long?
Well, I think you're right. I think there is a case to be made. And I spoke about this with Ryan Littlestone, your good friend, Blake, and mine, earlier. Sound like I was disowning him. And yours.
Yeah. He's okay, isn't he?
He's a good lad. We like him.
He's a good lad.
He's watching.
I was talking to him earlier in the week, and there is actually a case to be made to say that, central banks were kind of scarred by the whole transitory episode where they just ignored inflation for a year, and clearly got that very, very wrong. That actually you would now say they would err on the side of overreacting and staying too high for too long, rather than cutting rates and actually potentially insulating from a shock to the growth side of things. But it does obviously bring the risk of a resurgence in inflation back to the table.
It's almost a definition of insanity, isn't it?
Well, almost,
the Einstein definition of repeating your mistakes and repeating your mistakes, hoping for a better outcome.
Yeah, exactly that.
Well, I did say earlier 5.25%. I meant I need to clarify it's where the Fed's at is 5.5%. But regardless, we're at a restrictive, at least what people view that most central banks around the globe feel is restrictive. Now let's talk a little bit about something that you mentioned just a few minutes ago, Michael, where you talked about FOMO. And one of the thought processes that has been going through my mind is, you have a situation, especially this year. I want to say literally since not only the Fed, but other central banks have been raising rates. It's made what we call like macro is back in style, right? Everybody's a macro economist, and everybody's got, their ideas of where they think that the economy should be going. And there's a lot of macro economists that have their paid services that they shill out to institutions and funds, and everybody, generally speaking, has been looking at a recession is hitting this year in 2023. And obviously here we are at the end of 2023. U.S. economy is still going fairly strong based on most measures. And what I fear is, and then I'd love to get your comments here, what I fear is this FOMO that's coming in at the end of the year. It is because you have underperformance of so many institutions, so many funds. And wouldn't it be something if here we are at the end of the year, everybody's plowing into equities, and then all of a sudden equities find their peak sometime in the month of December, and we start to see some selling come in sometime. And we got a lot of stuff that's happening this week. We have U.S. jobs report. I think we just got past the RBA. Next week we have the FOMC. We have inflation data. So I'm going to stop there and say, what are your thoughts about where equities are at now globally? You got the DAX; it's almost at all-time highs right now. Should we be chasing the markets higher?
Certainly not the DAX.
Well, no, I don't. No,
Why?
the
The German economy
case, isn't it?
is stellar.
I think you nailed it, mate. In all honesty, I mean, if you put yourself or one of our viewers, puts themselves in the shoes of an active fund or asset manager who is coming to the end of the year, they have, for whatever reason, underperformed their benchmark. They are going to have to justify that performance and, more importantly, justify their management fees to the investors who have funds held with them. And if they're trying to do that, firstly, they're going to want to try and catch up to the benchmark, which in most cases, the S&P 500, as much as they can. So what are they going to do in order to do that? Well, they're going to go and buy the whole index and hope that it rides higher. And secondly, it's going to be very difficult if you have underperformed the benchmark to write your year-end investment letter or presentation or whatever it is, or email these days, I imagine, and justify why, for instance, you're not holding Nvidia or you're not holding Meta or Microsoft or, this magnificent 7 stocks that have just propelled the market higher. So you've got not only FOMO, fear of missing out, I feel very American saying that, but you've also got what we would call window dressing going on, where, effectively people are just buying the stakes in these firms to be able to put in their investment letter at the end of the year. We've got them. It didn't actually mean anything because we missed out on a 200% gain, but they're there now. And hopefully this makes you feel better about paying me a couple of percent to manage your money.
Well,
it's interesting though, like saying what's coming up with inflation and unemployment and the Fed. What do you think is the most important one? I know jolted the market today. I thought I'd get that in.
That was an awful pun. Even by my low
standards. But what do you think is more important now? Inflation or employment?
Still inflation, because I think the Fed will be very, very reluctant to cut unless inflation is either back at 2% or very, very close to it, if you think about core or super core.
And so I think they'll overshoot.
Yeah, to the downside. Yeah, I would agree. So I think inflation is still the one to watch. And then when inflation is back at target, that's when you watch the labour market. And as crude as it sounds, I think it could actually be as simple as an equation where you go, if inflation is at 2% and you get a negative non-farm payrolls number, does that spook the Fed into a cut at the next meeting? There's probably a decent case to say it would.
But what is unemployment? 3.9?
Yeah, 3.9.
I think they're comfortable with that. I think they're comfortable with 4.5%. I think it could run a long way before it really spooks them. I think they're more scared of inflation. I agree.
Yeah.
So you brought up another point, and I'm showing a picture of the dollar. You said, there's the market's flush with liquidity, and they're putting money into crypto, into gold. But what's with the dollar? We've seen the dollar really reverse out following the end of month. It was expected that we're going to see massive dollar selling going into the end of month. We got some dollar selling about the middle of last week, and then we've seen this key reversal off this fib level, and the dollar is catching a bid here. Does that concern you at all ahead of these key data points that we have coming up with the jobs report this Friday? Of course, we got other U.S. jobs report or other U.S. labor numbers coming out, like weekly jobless claims and ADP tomorrow. But more importantly, we've got the jobs report on Friday, CPI on Tuesday, and then the FOMC on Wednesday next week. Please explain to our viewers why the dollar is catching a bid here.
More buyers than sellers.
Oh, God.
Oh, we got that answer. We got that answer.
Why didn't I bring my yellow card?
I think that it overshot on the downside, basically. I think people have reassessed. I suspect people are convinced the dollar's going to go lower next year, and they've got their sell orders in too early and being squeezed.
Okay, wait, before you go on, then if that's what you believe, Richard, and you think that you're going to have to start wearing diamonds because you're buying dollars, what do you play it against? What are you buying?
Euro.
Well,
the euro.
Did you just take Michael's answer?
Favorite, the euro.
Shorting the euro. Okay. Michael Brown.
I short the euro against every currency. I didn't short the euro against the euro.
Wow. Wow,
The
that's a
trade of
big
the year.
All right, Michael. So
Sorry.
explain the dollar move that we've seen and how do you see it playing out?
Yeah, I'm a little bit of a different view to Dick, actually. I think that the move we've seen in the dollar is actually quite logical. If you think about everything that propelled the dollar higher over Q2 and Q3, rising geopolitical risk / general kind of risk off, equities slumping, all the rest of it, that has reversed course. Geopolitical risk is obviously still there, but the market's perception of it is a lot lower. Inflation has come down pretty significantly in the United States. Yes, that's happened everywhere else, but the difference is it's sparked a big rally in treasuries, so they're no longer providing support, and it's also sparked a big dovish repricing if you look at futures or the OIS curve of Fed expectations, which we obviously touched on. And perhaps most importantly, I think this idea, and we touched on this the other week, of US exceptionalism, that recently seems to have faded a little bit. Yes, we had, well in excess of 5% GDP growth in the third quarter, which is incredible, but it's also 3 months old at this point. And if you look at some of the data that we've had coming recently, I mean, just yesterday, for example, the factory orders number was nothing short of grim. I think it was the biggest fall in factory orders since April 2020, right at the start of COVID, of course. So I think actually what we're seeing is markets moving from a world where the dollar is the only game in town and the Fed are the only sort of hawkish G10 central bank and higher for longer, everyone's bought into it, to a world where those risks are much more evenly balanced. So if you think about the dollar smile, for example, we're now kind of back in the middle of that. That pendulum has swung back a little bit. And then I think going into 2024, I think the moves, and I've been writing a bunch of these outlooks recently, so forgive me if I sound like a broken record at this point, but I think the moves in the dollar are going to be much, much more selective. I don't think we're going to see a broad trend in the dollar against other G10s. So, the euro, for example, there's a very, very strong case that the ECB cut in Q1. Yeah. If the ECB cut in Q1, euro dollar is not trading near 110, it's probably nearer 105, if not below. But then you look elsewhere and you go, well, actually, going through 2024, the Bank of Japan are probably going to come out of their decades of ultra loose policy. So the yen should strengthen, dollar yen should fall. There's I would say a pretty solid case that the BOE are actually one of the G10 central banks that leaves bank rate the highest for longest. So would sterling well, yeah, absolutely that. So I think you've got to be a little bit more choosy and a little bit more picky about how you play the dollar next year. Yeah. I don't think 2023 was very much a broad trend in the greenback. 2024, I think, is going to be a lot more difference and divergence depending on where you look.
Well, that makes a lot of sense to me. And what you're saying is 2024 is going to be the year of FX volatility. And speaking of which, since you guys are obviously huge fans of the Bank of England, and tomorrow morning we have the financial stability report, and we're going to have Andrew Bailey, your favorite, Mr. Matthews, speaking. What should we expect out of the financial stability report out of the UK?
Nothing.
That's it.
Yeah, I can't swear.
That's all
we'll get in trouble if we say it.
Yeah, if we say what we really believe, we'll get in trouble.
Yeah, I mean, I can't even say that. No, we got to move on.
We got to move on. Come on, you're leaving us all hanging here at the Traders. What the? Okay, fine.
They don't know what financial stability is, do they? Let's be honest.
Let it all out.
Don't start.
Please let it out.
All I will say is, considering on the subject of financial stability, go and Google Andrew Bailey's track record when he ran the FCA, and then come back to us and tell us whether he's the right man to be talking about this sort of thing. Because the answer is no, definitively no.
I'll tell you a little story that I work with most of the guys, well, everyone I work with is younger than me. And I work with quite an achievement. It's really not a great achievement, but I work with quite a few guys who are in their early 20s. And I took one of them out to a meeting, or a couple of them out to a meeting in the city. And we're walking back, we walked past the Bank of England. And I said, do you know what that building is? And this guy turned around to me and said, it's the Albert Hall. And I said, pardon? He said, it's the Albert Hall. I said, no, it's a Bank of England. And I thought about it. I said, well, it could well be the Albert Hall. The bloody clowns you've got in there might as well be. The Albert Hall's a famous concert hall in London. And it just summed it all up for me.
It really does.
True story.
Well, you know, what I'm going to do is I'm going to turn the subject to what going into the last, since this is going to be us, you know, probably the last time we get a chance to meet, the three of us, between now and the end of the year. Let's start with you, Michael. What's your best trade going into the month of December?
Actually, do you know what? In all seriousness, this is not me trying to dodge the question or sit on the fence, but it is. No, in all seriousness, to any trader out there, retail, institutional, novice, experienced, whatever, the best advice I could probably give for going into December, and actually realistically we're recording this on Tuesday afternoon. By the time this goes out, we will have a week until the Fed meeting, and in my mind that's a week until markets really shut down for the festive period. So my best guidance and advice and comment to anyone would actually be to do nothing. You know, we spoke about this last week. If you've had a great year, brilliant, well done, pat yourself on the back. Shut your screen, shut your laptop, put your feet up, enjoy Christmas with your family and your friends. If you've not had a great year, you're not going to make it back in December. That is the honest truth of the matter. And if you try to, you really do run the risk of making things worse. So I would say actually manage any positions that you've got open very, very carefully, being aware of the thin liquidity and light volumes that we've got, as we saw with gold over the weekend, Sunday into Monday. And if you really must open any new positions, then keep them relatively small and with relatively tight stop losses, and don't hold on to them for too long, because now isn't the time for making big directional bets on any asset, in all honesty.
Sage advice, and way to wiggle yourself out of that one. Richard, how about you?
I couldn't scream more.
Oh my gosh, you guys are leaving me with nothing. You're leaving us with nothing.
Look to square off before non-farm payrolls this Friday, put my feet up and have a nice Christmas and not worry about the markets at all. You've got some big numbers out next week. You're going to have thin volatility. Any serious traders out of the market by now. Just, you know, thank God if you've made a profit, and pat yourself on the back, and just, you know, don't get too depressed if you haven't had a good year. You know, these things happen. Look towards next year and just have a good break with your family and friends.
Yeah, no joke. You know, and I don't want to. I don't mean to poke fun, and I totally am just harassing you guys. But you know, I mean,
as you always do.
Yes, I always do. But I remember I was on my way to New York to visit our office for our holiday party in 2019, and I mean, I think the Aussie ripped like 300 pips, like within a day and a half of me as I was traveling. I'm like, what the, you know, you get these thin markets, and no one wants to stand in the way. And so when trends take hold, they could really take hold and go a lot longer than you think. So I think it is sage advice, as much as I was harassing you guys. And I think it's everybody should take that to heart. But I do want to wish you both happy holidays to the both of you. Michael, I love your work. Richard, I love your work as well. What's the best way for? I love Richard more. Richard, what's the best way for us to follow your work?
I think the best way to address me. I like to be called sir. You can catch me at 1.io or my Twitter, which is, or X, my crossing the market at Dickie Matthews. And happy Christmas and a prosperous new year to you and everyone who's watching.
Thank you, Michael.
Early, I know that. But...
It is very early, yes.
It is early, but it might feel a little weird. But still, like I said, I think the next time we're going to end up meeting is post holidays. So, Michael, what's the best way for traders to follow your work?
Yeah, Mr. M Brown on Twitter or X or whatever we're calling it this week. I mean, it'll probably have a different name by the time we come back from Christmas, let's be honest. Or pepperstone.com and all the Twitter feeds and socials we have. And obviously to second what Dick said, thank you very much to everyone for watching and putting up with me once a month throughout the year. I hope everyone has a very, very enjoyable Christmas and a happy new year as well.
Well, thank you guys for joining us, and I tell you, I appreciate both of you. Happy holidays to the two of you, and to all of our listeners. And if you enjoyed what you saw here, make sure you give them a thumbs up. Subscribe to the channel down below so you don't miss any of this exclusive content, and make sure you follow these two gentlemen. They are really both wonderful works of art. Seriously,
thank you, Blake. Take care, mate.
Cheers.
Have a good one. Cheers. Bye-bye.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.